Hello everyone, I'm Claudia and today I talk about tokenization, a regulated infrastructure solution. The global secondary market for luxury timepieces reached 16.7 billion in total transaction value in 2025, representing an year-on-year increase of 36.4%. Patek Philippe, Rolex and Audemars Piguet continue to dominate investment-grade trades, commanding premiums that few traditional asset classes can replicate. Unlike equities or fixed-income instruments, these assets generate no dividend or coupon. Their value derives exclusively from scarcity, craftsmanship, and a persistent supply-demand imbalance that has proven resilient across multiple economic cycles. However, and this is the central tension we will examine today, the mechanism through which these assets are acquired, transferred, and liquidated have remained effectively unchanged for decades. While the asset class has matured in terms of valuation, the operational framework surrounding it has not. The investment thesis for luxury watches rests upon three pillars: finite supply, exceptional craftsmanship, and demographic demand that continues to expand globally. These fundamentals have inflationary periods, currency volatility, and broader macroeconomic correction. In essence, the asset has evolved, but the infrastructure has not. The appreciation is robust, but the mechanisms for realizing that value are structurally deficient. An owner seeking liquidity must engage a grey market dealer, accept a bid-ask spread, typically ranging from 5 to 15%, and submit to authentication processes that may extend across several weeks. Furthermore, the market offers no mechanism for partial divestment. The owner faces a binary outcome: full disposition or continued holding. There is no secondary market infrastructure that approximates the transparency, speed, or efficiency of listed financial instruments. To understand what is at stake, consider the Patek Philippe Nautilus 5711, perhaps the most emblematic timepiece within this asset class. The Nautilus 5711 was designed by Gerald Genta in 1976 and discontinued by Patek Philippe in January 2021. The stainless steel variant, distinguished by its portal case construction and blue dial, has become the definitive collectible of the past decade. Originally retailing at $34,900, the reference currently trades between $100,000 and $160,000 on the secondary market. According to Watch Charts data as of May 2026, the 5711 is priced at approximately $112,500, reflecting an year-on-year appreciation of 29.8%. Those figures represent a significant divergence from retail. To illustrate the long-term performance, an acquisition in 2015 at $25,000 held for a decade would have generated a return of 420%. Moreover, in November 2024, a special commission reference 5711 achieved 6.7 million, equivalent to approximately 7.56 million, establishing an all-time record for the reference. The investment case appears compelling, yet there are material fractions within the ownership structure itself, constraints that are threefold. First, illiquidity. As noted, the owner cannot execute a partial sale and there is no facility for fractional ownership. Second, opacity. Price discovery relies upon dealer networks rather than transparent order books, and authentication due diligence introduced both delay and cost. Third, geographic and ticket size barriers. The minimum efficient investment remains high for a broad segment of qualified investors, and these limitations are not confined to the top-tier references. Outside the three dominant models, the Nautilus, the Royal Oak, and the Daytona, the market presents a different profile. The average timepiece now trades at a discount of 31% or greater relative to retail, following 13 consecutive quarters of price declines. Given these structural deficiencies, what solutions are currently available to institutional and sophisticated investors? Tokenization offers a direct response to the frictions we have identified. The process involves placing a physical asset, in this case a Nautilus 5711, and with a regulated custodian, the asset is checked, insured, and represented by a digital token on a secure blockchain. This makes ownership easier and more accessible. Investors can buy and sell small parts of the asset without moving the physical item. All information about its authenticity, ownership, and history can be stored on the blockchain. Transactions become faster, simpler, and more transparent. Investors from different countries can also access the same asset with lower investment amounts. In this way, tokenization makes a valuable physical asset easier to own, trade, and access. To summarize, the luxury watch market is worth around 17 billion and continues to grow. However, buying and selling watches can still be expensive, slow, and difficult. Tokenization can make this process easier by allowing investors to buy small parts of valuable watches and trade them more easily. The assets already have a value. What was missing was simple, transparent, and regulated way to invest. Tokenization can provide this solution. Thank you everyone, and see you in the next video.